Let's see the Fed talking and see what's going on. When he talked, we started to go down. Let's see what's going on. Just wait. So far, so good. So far, so good, guy. So far, so good, okay? Let's see what's going on, guy. So far, so good. This one need to break. This one is called a NVIDIA is the bull plus. If it break right here, F 118, it go back to 120. When they break 120, go to 130. Okay, right there, guy. Let's see what he talking. Not no. See, the way the more he talk, the danger you get. Be careful when he talk, guy.
Strength of the economy and the labor market, and will continue to enable further progress in inflation as we begin the process of moving to we are not already in so force. We will continue to make our decisions meaning friendly. We know that reducing policy restraint too quickly could hinder progress in inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity.
Not good, guy. Look at him.
Considering additional adjustments.
Be careful. If this one break 16, it go all the way down.
Evolving outlook in the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward.
See, when
If
he
the
talk,
economy evolves as expected,
trouble.
the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median
See,
projections
cannot
are
break
lower,
right here.
consistent with the projections for lower inflation and higher unemployment, as well as the change to balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly.
Yep, right here.
If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to
Okay.
respond.
This one
Policy
is
well
night
positioned
cup
to
and
meet the
handle,
risks
guy,
and
right
uncertainties
here.
that we face in
See, you
pursuing
need to break
foresight
right here, 18, 118 to go back to 120.
Two goals for monetary
If not, they call back down here.
maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve Leisman, CNBC. Thank you for taking the questions. In July, you said you weren't necessarily benefit. You didn't want to be specific. You anticipated last week came out a little further
50, that means the economy not that good.
And I guess should we expect more 50s in the months ahead? And based on what-
Inflation is still there, but the economy not good.
So, okay, one question. Let me jump in. Since the last meeting, we have had a lot of data. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that
I think after he talked, the stock go down.
artificially high and will be revised down. We've also seen a total rate of resignation. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third? Sorry, thank you. How do we figure out in the months ahead, is there another 40 coming in, 50 coming in, based on what changed? Sure, so, a couple of things. A good place to start is this. Let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data involving that work.
Let's see the QQQ.
If you look at the S&P, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago, when inflation is high and unemployment low, to a place that's more appropriate given where we are now, where we expect.
You break out right here, go all the way up there.
There's nothing in the S&P that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection, that's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate, we can go slower if that's appropriate, we can pause if that's appropriate. But that's what we're talking about. And again, I would point you to the S&P as just an assessment of where, of what the committee is thinking today, but the individual members of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris McGiver, Associate Press. Thank you. The projection of the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest that you see rates as restrictive for that entire period? Does that threaten the weakening of the job market and inflation avoid? Or does it suggest that maybe neutral and neutral higher?
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person in the community, if you ask them what's your certainty around that, they would say there's a wide range where that could be. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at a given time. But realistically, we know it works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restrictions, and we'll be looking at the way the economy reacts to them, and that'll be guiding us in our thinking about the question that we're asking.
Start to go down.
Policy stance is appropriate.
It breaks 16, 115, 116, it started to go down. Okay.
July 2023.
Let's see what's going on right here. Important right here. Okay.
Inflation is 4.2%. Today,
Right here.
unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it's time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are how we
Look at here. See, and then anytime he talks, start to go lower.
sense of neutral. And
Why doesn't everyone between 45 and 65 claim the 200?
Howard Schneider with Reuters. How close was this decision? You have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity, excellent discussion there. I think there was also broad support for the decision that the committee voted. So I would add that look at this, all 19 participants wrote down multiple cuts this year, all 19. That's a big change from June, right? Seven of them wrote down 3 or more, and 17 of the 19 wrote down 3 more cuts, and 5 of the 19 wrote down 4 more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Expect this to be running every other meeting, once we get into next year.
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We need a good, strong start to this, and that's really a sign of our confidence. Confidence in inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start. But and I'm very pleased that we get, to me, the logic of this, both from the economic standpoint and also from the risk management standpoint, was clear. But I think we're going to go carefully meeting by meeting and make our decisions as we go.
Need your whole right here. Look at here. Same chart, guys. Same. This whole right there, 16.
And so I wonder if you can walk us through why you see the labor market stabilizing, what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy note today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace.
Yeah, we're growing while you cut rate.
The labor market is in a strong pace. We want to keep it there. And that's what we're doing.
Does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut function of the elevated nominal level of the policy rate such that the accelerated cadence could be expected to continue?
Multiple questions here. So I would say we don't think we think this is timely, but I think you can take this as a sign of our commitment not to get that. So it's a strong. Sorry, your other question was.
What happened in employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of funds rate relative to what might be expected if returning to maintain?
I think it's about we come into this with a policy position that was put in place, as you know, I mentioned in June. Hi, I'm JT, and I'm a results hunter, the search engine for conservatives. Let me just tell you what it does. First of all, big tech right now is run by a bunch of elitist people who all happen to know in the form of finance and so I think that is what enables us to take this strong look. I do not think that anyone should look at this and say, oh, this is the new case. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case,
GNLN.
That's moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower. That's what the base case is.
With a larger cut today, should there be any signaling for
about how the committee would approach end state on the balance sheet policy. So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet will come out of overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side in the sense they're both a form of normalization. And so for a time, you can have the balance sheet shrink, but also be prevalent.
Thank you, Gordon Smith, the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market and maybe improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in the direct talk with Gina is, why should we not expect a further deterioration in labor market conditions if RRP is to continue?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. And by many other measures, the labor market has returned to or below the 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, we're watching and we're watching.
And about starting to see rising layoffs. If that were to happen, would the committee already be too late in terms of the recession?
So our plan, of course, has been to begin to recalibrate. We're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. We're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that because there is thinking that the time to support the labor market is when it's strong and not when. And now we want the factors we consider. Of course, we need to look at the totality of the data to make decisions.
Like with the Bloomberg TV and to follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pressing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
That we're going to be watching all of the data. So if I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting capacity. We're also going to be looking at our other mandates. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time, every time. So, and policy is still restricted, so that should still be happening.
How sensitive you'll be to the labor market since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? we're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that needs to come sometimes with this inflation. That's what we're trying to do. And you can take today's action as a sign of our strong commitment to achieve it.
Hi, Jerome. There's just people from Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You mentioned a couple, but would you be able to walk us through what that dashboard told you as far as looking at the job market now?
Sure. So let's start with unemployment versus the single most important. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a low, that's a very healthy unemployment rate. And anything in the low fours is a good rate. So that's one thing. Participation is at high levels. It's, that you're right, adjusted for demographics, for aging, participation is at pretty high levels. That's a good thing. Wages are still a bit above what would be, the wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we'll go back then. Vacancies over, per unemployed is back to, but still a very strong level. It's not as high as it was. That number was 2 to 1, 2 vacancies for every unemployed person as measured. It's now below, around 1. That's still a very good number. So, quits have come back down to normal levels. I mean, I can go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment
Come down to what?
because we were so patient and
Come down to 10%. The whole system is scammed.
He chose muted.
We'll see another labor report. We'll see another job report. I think that it might be actually the second job report came out on Friday before. So, and inflation, we'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the following outlook and analysis of risks, and then go through our process and think what's the right thing to do. There's policy where we want to be to foster the achievement of our goals over time. So that's what it is, and that's what we're doing.
Mr. Powell, Texas, we've only been running a little over 100,000 jobs a month over the last 3 months. Do you view that level of job creation as worrying or alarming, or would you tend to kind of stick at that level? Relatedly, one of the larger trends in the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has started to run, or do you see risk that further labor market floating job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, then you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming to the country. I understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. But the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt, not all, we felt that job openings were so elevated that they would fall a long way before you hit the part of the curve where job openings turned into higher unemployment job loss. And yes, I think we are, it's hard to can't make these things with precision, but certainly it appears that we're very close to that.
Well, he start to go down, guys.
Will translate more directly into.
Try to go down.
But it's been a great ride down. We've seen a lot of tightness come out of the building from this point without the resulting forward movement.
Not good, not good.
Let's show back everyone's Fox business. So we've heard some speculation that midpoint for the fundraise of 3.5 to 4%. And it's basically the entire generation that has experienced zero or near zero federal fund rate and something related to inflation. What's the likelihood that cheap money will not?
So this is a question, you mean after we get through all of this? It's just a great question that we just.
See the way he talk? The market don't like it. Look at it. You need your hold right here, VWAP.
We're not going back to that era where there were trillions of dollars.
You need your hold right here.
Sovereign bonds traded at negative rates, long-term bonds traded at
15.
negative rates.
1550 right there. Need your hold right there.
So there were people issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But, it
You
feels.
see buyer step in right here.
to me, that the neutral
If
rate-
no buyer step in right here, go lower. Not good, guys.
I just don't think we know.
See, when he talk, that's the problem.
How do you respond to criticism that the likelihood?
I don't listen to him, guys. Forget about it. Just watching. Need to hold right here, 115.50. Not holding, we're in big trouble. That's it, guys. Down here, you need to get out or short it. You short underneath here. Look at this. You short right there. You short right there by buying an NVD. You see? You jump in NVD right here. Look right here. Need to hold right here. NVD right there, okay? You see? You need to hold right here, 115. Need to hold right here. 115. NVIDIA cannot break the ball flash, guy. Here the ball flash. Look, it break down right now. Look at that. You see, when it break here, the VWAP, you short right there, and then you cover when it on top of the VWAP. You can sell some right here. This one right here, 115. Not good, not good. Look at QQQ. QQQ collapsing. NVIDIA, short right here, cover some here, and short more when it break down here. On the VWAP, you cover it. Look here, very dangerous zone right here. When this one break here, this one break out. This one will got to break out right here. That's an A flush setup. Too short. NVIDIA. Short NVIDIA, guy. Look at that, guy. See? Right here. You short here. You cover up here. That means you buy here. You buy NVD. Look at that, guy. Look at NVD. See? Look at that. You see right here? You short here. This is an A flush setup here. Watch out right here. $2. The market going down. Look at here, guy. Market down, down, down. No good. See, after he talked, that's the part. Whoa. It's on all the way down, guy. The market down, down, down. Crazy, huh? This one go to $2. NVD. I think NVIDIA right here, 1350. 1350, maybe support right here. Need to hold right there. If not, you got indentures. 1350. Look at that, guy. They start to short right now. See, this one hit $2 right there. You see, it hit $2 right there. GSL. Oh, the short silver. GSL, short silver, guys. Silver going down right here. See, this is short silver. GSL. Gold come down, silver come down. Crazy, huh? terrible guy, NVIDIA go all the way down. See, you need to hold right there, 1350. It's hold right there. 1350 holding. You see right here, I try to hold right here, 1350. Go to break it. Maybe break it. Power lunch. Look here. QQQ breakdown. QQQ net down $21, up $100 something down right now. Crazy, crazy. All right, that's it, guy. The market down, down, down. Bye-bye.